Obviously, we've been going through an uncomfortable time period in the market, but it's one that's not unfamiliar. I've been saying that a lot here lately over the last 3 months, and I know it sounds like I'm on repeat, especially for Les, who hears me say this quite a bit. But this slide is going to show you how these types of declines are a normal part in an investment cycle. Now, it's going to be very important to know that we're talking about market cycles here, not an economic cycle.
That's correct, yeah.
Because
we'll be talking about economic cycles
in the next two terms.
Yeah, the next two terms. But bull and bear market, you're talking about stock market or bond market. And it actually doesn't even have to be, it's a market. You know, you can have a real estate bull and bear market.
Correct.
You know,
so it's not a wide stroke brush. But what we did do is we pulled this information from a resource, and it's talking about an index, what you just mentioned, S&P 500, and it's covering it from 1949 until 2020. So normally, this is average frequency, and people have forgotten this because even like last year, we had very little volatility.
Right.
So a lot of kind of head in the skies, blue skies and red roses. But normally, the average frequency in which we have a 5% or more decline, which is called a pullback, we usually have that happen 3 times a year. And that was very rare last year. I mean, and so let's look. Okay, well, what in the world's a correction? Well, a correction usually happens at least one time a year, and that's a pullback of at least 10%.
Right.
So
you just kind of expect that to happen. Yeah. I mean, I don't even think we had one of those last year. We may have. I might have forgotten about it, but last year was an anomaly. However, the year before that, we saw several corrections.
Correct, during COVID and everything. Yeah. So now let's talk about one of the words, the bear market. Now, what in the world, how do you define a bear market? Well, a bear market usually happens about once every 6 years.
Right.
And that's a prolonged period of time where the size of the decline is usually about 20% or more.
Right.
So this is nothing, it's uncomfortable, but it's not unfamiliar.
So as we're recording this on, what is today's date? It's May
today is
20th.
It all runs together. Yeah, exactly. So
as we're recording this, last Friday, the market touched right above a 20% pullback. And then we had a good up day on Monday. So we still are not in an official bear market territory in this pullback.
Yeah. That was some of the headlines that came out on Friday was that, hey, the market officially enters into bear market territory. Right. So you're more knowledgeable now if you're listening because you know what that means. And that means that we went from the highs down 20% or more. And if it would have stuck, then we would have been officially in a bear market.
Right.
But
that one thing to keep in mind is that's an average once every 6 years. Now there could be a 8-year period that you don't have a 20% pullback or a bear market, but there could be a bear market every 2 years, and that's how you get that once every 6 years since 1949. So.
Exactly. So these are averages. I mean, a pullback once a year, a correction of 10% or more. Very rarely does statistics track along the average.
That's right.